Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Neena Mishra. My guest today is Matt Bartolini, head of Spider America's research at State Street Global Advisors. We're talking about the market outlook and best ideas for 2020. Matt, welcome and thanks for joining us.
Yeah, thanks for being here.
So let's talk about the stock market performance this year first. So the S&P 500 is up about 25% year to date. The NASDAQ has done much better. It's up about 33%. That's mainly because of its tech focus. And if you look at the recent performance, November in particular was great for stocks. It seems that investors shrugged off all the negative trade headlines and mixed economic data and political developments, including impeachment hearings, and they continued to pour money into stocks. So what are your thoughts on the market performance this year so far?
Yeah, I mean, it's been great for investors. I mean, developed global stocks retested their 2018 all-time highs. The U.S., they naturally hit multiple all-time highs this year, and that strength really pushed the rally in global equities. I think what's interesting is that this year-over-year return differential, so if you take last year's sizable double-digit loss,
Right.
plus this year's 30% plus gain, and that differential is the 13th all-time going back to 1926, and is the greatest non-bear market bottom year-over-year rally since 1995, which I think that going back to that year is interesting because that was another year that saw the Federal Reserve use rate cuts to calm fears of a slowdown. So, and I think that's the big thing is that the Fed became more accommodative and sort of refilled the punch bowl, so to speak, and that led to sizable rally in a lot of risk assets and also pushed bond yields down to the point where, if you just even look at the broad ag has hit 50 new all-time highs this year as well as rates plumbed to lows, which we haven't seen in some time. So I think, if we look at the 60-40 portfolio, it's the second best return in a decade. So 2019 was a really strong year for investors. One of the underlying trends, though, is when we look at fund flows, I think a lot of these investors kind of missed out. ETF fund flows are a little bit off their pace from 2018, 2017. On the equity side, they still remain well below their pace and are unlikely to breach $200 billion, which they have hit every year for the last 4 years.
So do you think this rally can continue next year? You mentioned Fed's rate cut, and the Fed is likely to stay accommodative. And the economy seems to be doing well. But I think volatility could remain high next year. There are two big wildcards, the presidential elections in the U.S. and trade-related risks. What about the stock market performance next year? What are your thoughts?
Yes, I think governments and monetary policy around the world want to keep this party going, so to speak. Rates are low, credit spreads are tight. That means funding is cheaper to, fund different capital expenditures. Earnings growth is projected to be positive. So it sort of seems like serenity is up ahead. But I think in 2020, where we feel is that the margin for error and opportunity will likely be as small as it's ever been for a long time. And the way we came to that is around four different reasons. One is that the leader of these gains in 2019 has really been the U.S. Other regional markets such as Europe, Pacific, and emerging markets have not hit their new all-time highs. They're actually still well off their all-time highs, reached back before the financial crisis in 2007. I think what happens in the U.S., though, is, valuations are expensive. Using a 5-factor model, they plot in the 80th percentile, and typically high valuations lead to, lower future returns. That's one of the reasons why in 2020 we think that the margin for opportunity is lower than what it was starting in 2019. Secondarily, low bond rates are also meaning bonds are expensive, and there's a strong correlation between today's yield and future returns. If we go back and we look at the current yield to worst on the Bloomberg Barclays U.S. Aggregate Bond Index and its subsequent 3-year returns, there's a 95% correlation. So basically today's yield is similar to what your return expectations over the next 3 years will be. And if you look at today's yield, it's about 2.3%, so expect sort of lower returns, and not the double digits that we experienced in 2019. And the last two is just about growth and the fact that it's really not coming from organic means, but the fact that 2019 numbers are bad and 2020 by comparable will be a little bit better. I mean, margins have rolled over, so it's not organic means by any stretch of the imagination. And then as you put it, uncertainty. There's some sizable geopolitical risk. And overall, that's why one of our main themes is, the market environment is okay, that you should stay invested. The economy is doing okay, but seek to limit these downside risks because volatility can be a drag on the portfolio, and we're likely to continue to have these microbursts of volatility generated from macro reasons in 2020.
Very interesting. So stay invested, but limit downside risk. So are there any certain areas of stock market that look more attractive than others? How should investors position their portfolio?
So when we look at the overall equity markets, we sort of are still favoring the U.S., even though valuations are expensive, which is why we think you should have some sort of valuation component within your U.S. equity strategy, seeking to tamp down some of those elevated valuations. But across the pond, emerging markets and developed ex-U.S. stocks, they do screen as attractive. Mm-hmm. The only issue is they've screened as attractive for a couple of years now and continue to lag the broader U.S. And I think for the developed markets, they're likely to be impacted by those macro bursts of volatility, and it's a large part of your portfolio. So we feel that if you're going to sort of take that contrarian beta bait, that it's likely better in emerging markets because it represents a smaller slice of your portfolio if you're just thinking in it from a 60-40 market cap weighted paradigm. So we feel like in EM, try to take that value contrarian opportunity. Meanwhile, in the other spots, just remain invested, but seek out strategies that limit that downside volatility overall.
So any particular ETFs that you like for implementing these strategies?
Yeah, so within the U.S., there's a couple different ways to express this, positive but risk-aware view. And the three ideas that we're discussing with clients is about, one, just using a balanced multi-factor strategy that targets a lower volatility or a lower beta to the market, but still provides upside participation through a diversified factor approach targeting quality and value stocks. So that's something like a QUS, the SPDR MSCI Strategic Factors ETF. It combines quality, min-vol, and value together, and it seeks to have that upside participation but mitigate downside risk. The other ones are, targeting firms that have capital discipline. So something like dividend growth firms. A fund like SDY targets stocks or firms that have increased their dividend for 20 consecutive years. So that's a bit of capital discipline, and that can act as a potential buffer in periods of market stress or concerns over growth. And then the last within this volatility spectrum is really just focused on pure low volatility strategies. Still maintaining a beta to the broader market, but ensuring that beta is in a low beta form. So still staying invested, but not taking on as much market risk overall. And that would be something like a LGLV.
Mm-hmm. Very interesting picks. So let's talk about the hottest sector this year and very popular with investors, technology. It is the best performing sector year to date, up about 41%. So what do you think of the technology sector, and are there any areas within technology that you like better? Because semiconductors have done much better than the broader tech index, and they look kind of expensive now.
Yeah, which I think is kind of at odds with what people may have expected, given the sizable amount of revenue generated from overseas within tech and broadly semiconductors. I mean, semiconductors, about 80% of the revenue is generated from overseas, and we've had a seemingly stronger dollar over the past year, not sizably, but somewhat, but also the trade tension. So from a sentiment perspective, but it seems to be that both tech and semiconductors have been able to power through those headline risks and drive returns. I think when we we do a decomposition or an attribution analysis of what's driving those returns, it's really from multiple expansion. Growth within technology has been somewhat flat, and it's all been from a re-rating of the P, of that price-to-earnings ratio. And I think this can partly be explained by some of those trade tensions, because during the year they started to ease and cool a bit more,
Right.
where I would say probably not get as harsh as they originally were planned. We've seen more extensions. So I think what we're seeing here is that it's a little bit of buying the rumor of softening trade tensions. It'll actually be interesting to see what happens when any news hits from a tech sector, if there's a little bit of a dip, because overall growth this year is relatively flat, but overall from a long-term perspective, growth continues to be there, so it remains still somewhat attractive for those growth-oriented investors. From a sub-segment perspective, I think one of the really interesting areas is software and services. So global spending on information security is projected to grow basically at a compound annual growth rate about 9.2% through 2022. And you have worldwide spending on militarized AI projects to increase to about $118 billion by 2023. So there's some secular tailwinds behind the software and services segment of the marketplace, and thinking about cybersecurity and future of national and enterprise security. And that's reflected in some of the growth projections of software services. It's basically 20% EPS growth over the next 3 to 5 years. So this can be implemented through a sector or industry ETF like XSW. It focuses on the software and services industry. And also I think the added benefit is if we do have a renewed bout of trade tensions, or maybe the rumor is not as good as the news, it's interesting to point out that constituents within XSW generate only about 30% of the revenue overseas, as opposed to upwards of 60-70% in some of the bigger tech firms.
Yes, XSW is a very interesting ETF, and in fact, I hold it in an ETF investor portfolio that I manage for our clients, and I agree that it's a good pick in the current environment. Now, let's talk about healthcare, which has rebounded very strongly in the past few weeks after lagging behind earlier this year. And within healthcare too, biotechnology has done very well, because there are so many mergers and acquisitions in that space, and so many new studies coming out, FDA approvals and all that. So what do you think of the healthcare sector, biotech sector? Your ETF XBI has done very well recently. What are your thoughts on the sector and biotechs?
So healthcare broadly has been underinvested. There's been sort of a bearish view on healthcare for the better part of 2019. We look at it from a fund flow perspective. Fund flows in healthcare ETFs, we look at it on a rolling 3-month trend, and we notice that rolling 3-month trend dipped below the 10th percentile ranking over the last 5 years, and it hadn't gotten that low since around 2016, when then Democratic candidate Hillary Clinton tweeted out about price gouging. Mm-hmm. And so I think that's emblematic of the regulatory overhang on healthcare stocks, particularly around drug pricing, insurance, and the opioid crisis had really weighed on sentiment for the better part of 2019. And that actually made valuations quite constructive. Mm-hmm. So we look at it from a quantitative perspective using a 4-factor model. And we see that relative to other sectors, valuations are, based on whichever month. A couple months ago, it was number 1 ranked valuation sector. This month it's 2, as we've seen some strong price momentum over the last 3 months. And we made a case for healthcare back in around September, October timeframe that given the impeachment inquiries, a lot of the regulatory overhang would be sort of taking a back seat, that it wouldn't be a primary focus anymore, likely of the campaign trail for now Democratic presidential nominees and candidates, but also for Congress. Mm-hmm. And I think investors started to witness that, particularly as how the broader U.S. equity market was becoming elevated from a valuations perspective, and saw that healthcare not only sported constructive valuations, but also had some really strong earnings sentiment and earnings growth. And in a market devoid of growth, companies that trade at cheap multiples and have strong earnings growth prospects tend to warrant your consideration. So the removal of that regulatory overhang, constructive valuations, positive earnings sentiment, but also the non-cyclicality of the healthcare business, where in part, historically, healthcare has done well in economic slowdowns. And based on our analysis of the leading economic indicators, we are in a slowdown. So you take it from a macro point of view, a quantitative point of view, but also then a fundamental one. And it seems like healthcare was a sort of a sneaky, good, contrarian opportunity. And lo and behold, over the last few months, we started to see some inflows in healthcare, and then obviously positive performance. Over the last 3 months, it's been the second best performing sector next to financials, but only by about 10 basis points. So we think that will continue, just given that valuations are still constructive, sentiment is still positive from an earnings perspective, and that regulatory overhang is still likely to be in the back seat as the impeachment inquiry continues. As far as at the sub-industry level, XBI, it is a higher beta exposure and definitely gives you more of a growth-oriented feel, particularly around M&A, given how late we are in the cycle. I think one of the more interesting ones is healthcare equipment. So an ETF such as XHE, the constituents within there, they are projected to have earnings growth much higher than the broader sector, but also 5 times higher than the broader S&P 500. And it's likely from a secular tailwind of aging demographics, so the need for more wearable medical equipment as well as devices and monitors. But also it's likely to not get as much regulatory scrutiny if that does come back, given that it's not involved in the insurance industry or sort of price setting. It's more about equipment firms and their ability to provide devices for the aging demographic base. And over the last 5 years, healthcare equipment has actually outperformed pharmaceuticals, biotech, and healthcare services, as well as the broader healthcare sector. So XHE is something that we had profiled a few months ago, and we continue to point out for a growth opportunity within a sector that sports constructive valuations.
Very interesting. Now, I wanted to talk about the worst performing sector this year too, which is energy. It is up just 4.2% this year. And in fact, because of energy's poor performance, its market capitalization in the S&P 500 is now down to just 4% from about 13% back in 2008. But we have seen that some billionaire investors, including Warren Buffett and Sam Zell, they have been betting on some of these beaten down stocks. So do you think energy looks good from valuation perspective? Can it rebound in 2020?
So, I think beaten down is a correct adjective for the sector. It's still 40% below its all-time high, which was reached about 1,400 days ago. And if you look at the underlying stocks, 80% of them are actually below their all-time high as well. So there's only a few stocks that are actually doing well within the sector. And if we take a sort of put our quantitative lens on that we apply to a lot of things, valuations, they look great. Based on our 4-factor model, valuations are the most attractive out of any other sector. But are they cheap for a reason? When we look at earnings sentiment is extremely negative. So they're likely a value trap. So I think there's just, from a quantitative perspective, they don't screen as attractive. But also, we just take a step back and look at a macro case. There's a lot of political risk, whether it's trade, new regulations, depending on what happens in the 2020 election, but also, concerns and sort of infighting among OPEC and what they're going to be doing in the future, and then just basically tensions in the Middle East. So I think there's just far too much political risk. So it's cheap, but, it doesn't seem to be an ideal long investment because of the volatility. I think if you're going to be expressing a positive view on oil, you're going to require a steel stomach.
Yeah, I think energy ETFs, they look more like value traps than value plays. And investors in general, they are not in favor of energy stocks because of environment concerns. So I think energy is best to be avoided. So I wanted to talk about bond ETFs now. And bond ETFs have been very popular this year. In fact, inflows into bond ETFs have exceeded inflows into equity ETFs this year. And bonds have done really well, but the rally really took a breather in November. Despite that pause in the rally, bonds do look expensive. And you also mentioned earlier during this discussion, the 10-year note is now trading close to 1.8%. So in this environment, are there any areas of bond market that look attractive to you?
So when we're looking at the different bond sectors, we want to look at sort of the risk expressed within fixed income and how that relates back to the broader equity portfolio. You cannot destroy risk; you can only transform it. So understanding that our view is that the yield curve will likely be in stasis this year. We don't expect it to vastly move out of the range that it's traded within the last 15 months, be it between 14, 25 basis points, excluding that brief period of inversion that was quick and over and done with in a matter of weeks. So with that view, it almost makes sense to go tactically long duration. But we do feel that there could be idiosyncratic surprises, whether if trade breaks positive and there's a growth reflation, the low yield environment is unlikely to offset any duration-induced price declines. That yield is just no longer sufficient given how low rates have become. So I think in sort of a rates market perspective, where we're thinking about our duration risk, we'd want to strike a balance between yield and duration and look at something with a yield per unit of duration that is attractive. And that brings us to something like 1 to 10-year intermediate corporate bonds. The yield per unit duration is attractive. It's around 0.45, 0.59 on a 0.45 on a 1 to 10-year Treasury, but if you all of a sudden take on the credit risk, you go up to 0.59, and that's much better than the ag, which sits around 0.41. So you're basically able to get a higher yield in the ag with much less duration. So we like the intermediate part of the curve, whether it's in the Treasury or in the corporate market, but also something like mortgages. So mortgages, you pick up about 10% more yield than the broader ag, but you take on roughly 45% less duration. And mortgages will have a benefit of the Fed being on hold because we will see the pace of refinancing slow. We've already started to see it slow as they came out and told investors that they were going to be on hold. So I think there's a little bit of a tailwind there from a mortgage perspective where you can pick up a relative yield higher than the ag without taking on as much duration. And then within the credit side of the portfolio, high yield still has a place strategically just because of the carry associated with it. Particularly if you're also going sort of underweight equities or market weight equities, you can express a risk-on view with high yields because it has become more correlated. But I think if you're trying to diversify your risk exposures, going into something like emerging market debt. So emerging market debt is another sort of higher yielding part of the fixed income universe, has a yield over 4.5%. And it's largely investment grade. But what's interesting is that you're transforming your risk. You're not taking on as much credit risk because the risk profile of emerging market local debt is fueled by currency. So you're able to really transform that risk profile while still being able to hunt for that yield. So from a sector perspective, we like intermediate credit, mortgages, and EM debt. For EM debt, there's very different ways to play it, whether it be hard or local. A product like EBND provides local diversified exposure to government emerging market debt.
So EBND, which is the SPDR Bloomberg Barclays Emerging Market Local Bond ETF, and you mentioned mortgage-backed securities too. So is the SPMB SPDR Portfolio Mortgage-Backed Security ETF the correct ETF for getting that exposure?
That's correct. And on the intermediate credit side, something like SPIB, the SPDR Portfolio 1 to 10-year investment grade corporate bond ETF, provides you that slice of that corporate bond market.
Okay, excellent. Now, both bonds and stocks look expensive, and both have done very well this year. So considering both areas of the market are expensive now, should investors look at some other strategies which have low correlations to these traditional markets?
Yeah, so, like I said, bonds and stocks are expensive. They both plot in the 80th percentile based on valuation metrics, whether it is, the four or five factor valuation framework we have on equities or just looking at bond yields and fixed income. So given the sizable amount of macro-induced volatility where we're likely to have shocks, whether it's to both equities or fixed income, it is opportune to seek out strategies that have a low correlation to each other. I think historically people might focus on something like commodities or REITs or hedge funds, private equity, but what we've seen is the correlation structures of those increase significantly from basically pre-financial crisis to post-financial crisis. The correlation structures have increased, and wouldn't be able to provide that sort of benefit to the 60-40 portfolio that historically had. One area that's been able to maintain that historical sort of low correlation framework, whether it's pre or post-crisis, has been gold. So, gold's been able to mitigate volatility shocks both from the bond market and the equity market based on our historical analysis of changes in the VIX and the MOVE index. So we think, being able to carve out something for an alternative solution with gold, I think is beneficial in this type of marketplace where both bond and stocks are expensive, but macro volatility is unlikely to go away in 2020.
Yeah, gold is definitely an interesting pick. And your SPDR Gold Mini Shares Trust ETF, ticker symbol GLDM, which charges just 18 basis points, is a great way to get that exposure. And in fact, I hold that ETF too in the ETF investor portfolio that I manage. Now, switching gears a little bit, could you tell us a little bit about some of the recent trends you have seen from the fund flows?
Well, like I said earlier, there's been sort of low participation rally. Equity ETF fund flows have not been as robust as previous periods. Like I said earlier, equity ETFs alone, particularly on the U.S. side, will be the lowest in the last 4 years in terms of overall fund flow figures. The biggest trend has been fixed income, as we noted earlier. Have already broken records on their yearly total. I recently wrote a post about sort of the drivers of the growth and where that's going to be headed going forward. So this 4 C's of fixed income ETF usage growth. I was also putting out a projection based on an ensemble model of where we might see assets by 2022, which is naturally higher because we continue to see investment in really not so much in just your generic fixed income exposures, whether it be government or treasuries, but also into areas like preferred stock, convertibles, but then also high yield. This year, high yield ETFs have posted the most flows they ever have posted before. They're over about $15 billion right now, and that's basically off a year where they posted the worst flows ever. So it just really shows how investors are using ETFs to build sophisticated and flexible portfolios based on market dynamics, and it's not really all this buy and hold opportunity set. So those are the big trends. The last one really being defensive factor positions. Given how low rates have become on the bond side, we've seen a preference for bond proxies like dividend yield exposures, but also quality and low volatility factor ETFs. Low volatility ETFs have been the leader all year up until the last month or so, when the market really turned a corner from a rally perspective, and low volatility started to have some outflows alongside momentum, because those two had become highly correlated in 2019 based on rebalancing during periods of market stress. But I would say the big overriding trend for 2019 has been investing with a little bit of caution, and I can see that with the underinvestment in equities and the favoring of defensive, more bond proxy areas of the marketplace.
Very interesting. That's all we have time for today. Matt, thanks again for joining us.
Thank you.
Thanks for listening. Let's quickly summarize some of the ETF tickers that we discussed today. SPDR MSCI USA Strategic Factors ETF, ticker symbol QUS. SPDR MSCI EFA Strategic Factors ETF, ticker QEFA. SPDR S&P Dividend ETF, ticker symbol SDY. SPDR SSGA US Large Cap Low Volatility Index ETF, ticker symbol LGLV. Then S&P SPDR Software and Services ETF, ticker symbol XSW. SPDR S&P Healthcare Equipment ETF, ticker symbol XHE. And then the Gold ETF, SPDR Gold Mini Shares ETF, ticker symbol GLDM. If you want to learn more about these ETFs, please visit State Street website, usspiders.com. Make sure to be on the lookout for the next edition of ETF Spotlight, and also make sure to subscribe. If you have any comments or questions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.